Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. And in today's video, we're going to talk about the data that came out last week, the employment data that you're going to expect to see coming out this week, and how that can impact financial markets. A lot of data came out last week. We primarily got data around durable goods sales. We've got manufacturing regional survey data from both Dallas and Richmond. We closed the week with the final GDP estimate, and we saw some really strong numbers out of that, particularly strong from the consumption perspective. You're going to see that show up in the personal income data and the core PCE price index data as well. And really the title of this video is "The Economic Data is Improving." Now, that's both good and bad, and I want to take both sides of this equation. It's good from the perspective of, hey, the economy is being more resilient than anyone has given it credit for. It's bad from the perspective of it makes the Federal Reserve's job difficult in setting policy. If you think about it, if the economy remains resilient, in the face of a 500 basis point increase in interest rates, and the Fed's looking at this and they've seen progress on the inflation front, but yet they're not to their 2% target, what do you do? Do you hold policy where you are, or do you continue on the restrictive path until you get back to 2%? That's a question for the policymakers, but from us as investors and market participants and data watchers, we're primarily looking at this and saying, hey, if the economy is more resilient, that gives the green light to the Fed to keep raising rates, and that could create a problem later. It's not creating a problem now, as you're going to see from some of the data that's coming out. The economy's held up really well in these rate hikes. So let me do that. Let me dig into the data. Let me show you what happened last week. Let's talk about how that can impact the Fed's decision and how that can impact markets. So let's get started here. Let me share my screen. Here we go. Let me start by showing you some personal income data. Now, I'm starting here. I know it came out at the end of the week, but the personal income data, I think, paints a picture of why we are seeing some stronger numbers here in some areas. So particularly what you saw on the personal income data is you saw a 0.4% increase on a month-over-month perspective. That was greater than the estimate. The estimate for the month was only supposed to come out as 0.3% month over month. So it came in a little bit better than expected. And you can see from a trend perspective, let me grab my highlighter here. From a trend perspective, it's trending higher. And you can see that it is back above trend to the tune of about $26 billion above trend. That's a great sign of improvement in the economy. You saw deterioration, you saw flatlining, and now you've seen this recovery. That's really good improvement in personal incomes. Now, this is nominal. Let's kind of scroll down here and take a look at real. Real has flatlined. It is above trend. It's about $39 billion above trend. But again, you can see the decline, you can see the flatlining, and you can see the reacceleration. So again, all of those are really good signs. I like to look at personal income with transfer payments inside of it, particularly because of just the shape that this current cycle has taken. The fact that there were 3 rounds of stimulus checks, I want to see that in the data. I want it to reflect in the data. Some people remove it, and I think even the NRBR, the National Bureau of Economic Research, they also remove it as far as their key indicators for coincidental economic growth, but I leave it in, at least for this cycle, because I think it paints a clear picture of what has happened pre-COVID, post-COVID. Now, if you come down to look at real personal income versus the trend from a year-over-year perspective, you can see that it's running at 1.5% above trend and 1.5% year-over-year. Trend's actually negative, but you can see the trend starting to flatline too here. So that's a good sign for personal income. If you think about this cycle and everybody that has called for a recession, 2 things that stick out to me right now is you've got personal income still doing extremely well. You've got employment still doing extremely well. That's keeping consumption elevated. And this consumption data, you're going to see it kind of show up here in some of the durable goods orders here in just a second. Let's come down a little bit. The other thing that we're seeing is personal income receipts, dividends, interest payments, total, all of those are still accelerating, and that provided a really good boost to this specific monthly report. It was wages and salaries, and you can see that here. So you can see wages and salaries kind of reaccelerating a little. It's probably better to look at it on a year over year. It's below trend, but look, it's kind of bottoming here. So again, some improvement there. So, you are seeing this, but at the same time, you're seeing some savings pick up as well. So you can see savings is above trend. It's about $4 billion above trend. And it's 4.6 on the savings rate, not $4.6 billion above trend. It's just above trend right now in general. So the fact that they have more income, they have the ability to save more, that means they can spend more. And that's what really showed up in the inflation data. What you're going to see when we looked at the personal consumption expenditure and we looked at that data, there was almost an $18.9 billion increase to consumption. $52 billion of it was services, were only 33 of a decrease. $33 billion were from energy, transportation, things of that nature. We started to see those slow down as well, like vehicle sales. So to see that separation, you're going to also see it show up here in the PCE price inflation data. So let's come down here for a quick second. So here's the headline PCE with both food and energy included. And you can see that that's really tracking well back to the 2% target the Fed wants. You're at 3.7% here. The Fed wants to be at 2%. A lot of the deceleration has come from energy, with oil trading below $70 a barrel, but food is actually helping lead this decline as well, as food continues to come down, albeit somewhat sluggishly. If we take food and energy out, which we know is volatile in nature, that gets us to about 4.6%. That's where the month over month increase was only 0.3 relative to 0.4 that was estimated. And you can see that, again, it is still coming down. It's still closer to the peak than it is to the 2% target. And so this is something the Fed is going to continue to look at. And again, I would argue that it is services that is driving all of this, with, again, another $52 billion print coming from the service consumption side of the economy versus the goods side of the economy going down $33 billion. Again, you can see the goods, as far as the energy side, being down 13.3% year over year, food coming down from greater than 10% just a few months ago down to 5.76%, where services barely peaked just a few months ago and has been coming down slowly. We know rent is the key component or the key problem to that. We've highlighted why we think that's going to be coming down soon. But definitely services, airline travel, international travel, those continue to drive this inflation problem that we're seeing. And it's also driving the consumption basket from all of this increase or this reacceleration that we're seeing in personal income. So if the consumer if they have a job, if they have more income and they begin to spend, that's going to start showing up in the consumption data. That's going to show up in the inflation numbers, and that's going to keep the cycle going for longer than people were expecting. Now, remember, let's reevaluate where this is coming from, right? So again, I think we talked about this before, but if we have like GDP, and we have the inflation rate, and let's just take a demand, just a starting point here, and then let's take the inflation rate at some level here, and then let's take potential, which is going to be right in the middle of those. So this is the starting point of this cycle. We know that demand reaccelerated to a point where, after all the stimulus came through, it created inflation. Now they've been raising rates to cool demand. So now we're in this phase where demand is slowing. That's what happened all throughout 2022. And even to some extent, maybe somewhat of the fourth quarter of 2022. So you get this reduction in demand. And what that is supposed to do is it's supposed to bring down the inflation rate. So the inflation rate comes down. What happens is now, initially, you create this little recessionary gap, which again is probably 2022 activity. And then when prices come down enough, you re-accelerate demand because prices have come down, and that's what gets you back on track to potential again. And so this is something that I've been thinking about and arguing about, is that, hey, look, when inflation comes down enough, people that were putting off projects, people that were putting off activity because prices were too high, they're going to come back at some point. There's going to be a price point that's going to make them do that project or complete that economic activity. That's going to filter into higher GDP growth, stickier inflation. And that's kind of what we're seeing in this GDP revision. In fact, when the GDP final first quarter estimate came through, it came in at 2%. Where it originally started at 2.6. So it did weaken a little bit, but everybody thought it was going to weaken to 1.4%. Where did the strong number come from? It came from consumption. So again, the consumer is being more resilient than people are giving them credit for. And again, it's because we've not seen large job losses. In fact, one other area that we're seeing some strength from the consumers is new home sales. So the prior week, we got existing home sale data. New home sale data came in almost 12.2% greater month over month. That was a surprise because many estimates from economists were thinking that they were going to come in much lower. My estimate was high, but not 763. It was 689,000. I'm sorry, 689 million. So I was not expecting this number to come in the way that it did. What we've been seeing, however, is inventories have been drawing down. The month supply of homes at 6.7 months supply. So still quite a bit of inventory, as you can see on the marketplace, but that is starting to slow down a little bit, and those home prices are starting to come down a little bit as well from their peak. However, if you could zoom in, and it's hard to see here, if you could zoom in, there's a little hook higher here over the last couple months. It's probably easier to see it in the existing home sale data as this price has creeped higher and higher. That affordability is something that I'm looking at. If you take a look here at 6.71 on a 30-year, coupled with that $416,000, the home loan proxy is now at just a touch over $2,800. That's keeping it well without of reach for some families here. So this is more data that showed signs of improving. So last week we got the building starts and housing permits. Now we've got personal income that's improving. We've got consumption that's improving. Home sales are improving. So you're starting to see things go from, okay, an outright decline to a stabilization to some data starting to hook a little bit higher here. It's so important for us to make a note of that. Why is it important for housing particularly? Housing is a big component of GDP, that residential fixed investments. There are estimates that now this current slew of data is going to actually add 0.7% to GDP estimates compared to where they were subtracting greater than 1% from GDP. So now that you have this improving data, you're now seeing a situation where GDP estimates are starting to float higher for the second quarter. Stick with us, or if you're already a subscriber, you can go onto our website and you can pull our GDP estimate for Q2. We still expect it to be below trend, below that 1.8% on a year-over-year perspective. It's important that you call out how you're measuring it, but it's definitely going to be stronger than I think people are giving it credit for here. Now, again, this is all painting a very similar picture of inflation's coming down, which means there's progress for the Fed. Consumers aren't necessarily losing their jobs. They're actually getting pay raises, which is still helping them afford some of the higher prices that we do see in the economy on some things. But I do want to address that employment side particularly. One, because we got a surprise on the initial jobless claims side. Initial jobless claims down to 239,000 jobs. I didn't expect that. I expected us to stay in the 265,000 range. I thought that the trend was directionally higher. It looked to me that employment was weakening with another signal that I use, which is down here at the bottom. The Kansas City Fed employment index is directionally lower and it's negative. And so I thought that there was plenty of weakness there for me to continue to forecast a slow grind higher. in initial claims. Again, this goes back into the economy being more resilient phase, or maybe economic data improving. We have to ask ourselves, okay, was there some seasonal adjustments that were missed? There was a holiday in the period, so maybe that also maybe distorts initial claims. But one of the other things we have to think about is, well, how are people eligible to begin with, right? Well, maybe they're on a waiting period. Maybe they're finding a job quickly, right? Maybe they're not staying on initial claims very long. A couple new charts that I've put in here to help us describe this, because we're still seeing this divergence where initial claims is moving higher, where continued claims is falling. Again, another report where initial claims was lower, 1.742 versus 1.759. So again, it continues to slow down. So two more things that I think are going to help us. One is just the total amount of people receiving benefits. And then two is looking at the average week that they are unemployed. Now, why did I look at this? I have to give a shout out to someone who recently left me a great comment. They said, hey, Grant, is it possible that this divergence in continued claims and initial claims could be that people are running out of benefits? Could it be that they have filed way too long, therefore, going past the maximum that they're allowed to get benefits, and then that would keep them unemployed, but keep them ineligible from receiving anything else? Although, again, strengthening that argument that, hey, maybe the economy's not doing so well. I didn't really see a big increase from that cohort, and I want to show you why. Particularly when you look at the average week of unemployed, it's currently sitting at 21.2 weeks. When you look at state requirements across the 50 states, it varies state by state, but the average maximum benefit that you can receive is 26 weeks of unemployment benefit assistance. So you're seeing this, one, do two things. One, it's increasing, meaning that the trend of average weeks unemployed is rising. Two, it's very close to that max unemployment benefit. If you go past 26 weeks, it's clear to me that you're not going to be receiving benefits at that point. Now, how many people are actually over 26 weeks unemployed? Well, you can see here 1,188 thousands of persons, so about 1.2 basically. So of the 1.7 million, 1.8 million unemployed, there's just a few there, 19.8%, that are unemployed for more than 27 weeks. Now, caveat to that, that is accelerating. So you can see that that's increasing. So that shows us that there are people that are out of work and also not receiving benefits. You can also see that a strong increase into the positive territory. These usually coincide with recessions. So you can see that it also shows it here, maybe better in the picture of just the level versus the cycle perspective. But still, I wanted to put this on here to help answer that question. Why would continued claims be falling while initial claims is rising? Well, again, it can only be one of those three answers. It can only be that there's some type of waiting period. Maybe they're ineligible to receive benefits, or maybe they're finding new jobs, which is also a possibility. 19.8% of people over 27 weeks unemployed, it's not a whole lot. When you look at some of the other data, like 35% of those unemployed have been unemployed less than 5 weeks. So, again, I think this is just more data to help us understand the labor market. We know demand is greater than supply right now. We know that job losses and layoffs have picked up recently. And so to me, it definitely seems like the labor market is weakening here, but not all out in the job loss perspective. Again, if you're a subscriber, you can check out our forecast for where we think unemployment is going to go towards the end of the year. That'll help kind of anchor you as well as far as my expectations of where I think these things are going forward from here. One other tidbit that I can give you is by looking at regional Fed survey data. Now, again, this looks at the manufacturing side of the economy, not necessarily the service side of the economy. And I'm going to pull up the employment composite here real quickly. We did get the Dallas Fed and the Richmond manufacturing. Dallas Fed improved slightly, coming in at minus 23.2 compared to 29.1 on the prior month. Richmond came in a little better as well, minus 7 versus minus 15 on the prior month. If you look here just briefly at the composite regional Fed survey data for employment, you can see that employment has stagnated. Has improved and kind of moved sideways here. I think that's also important for us to note as well whenever we're talking about initial claims and the health of the consumer. So you've got personal incomes higher, you've got consumption higher, you've got inflation coming down. So that is helping fuel some economic activity as well, as their dollar is actually going a little bit further here. And then from an employment perspective, we've gotten a temporary reprieve here of layoffs. We've got some people that actually maybe have found some jobs and maybe are getting back to work. And you're probably seeing it echoed here in the composite survey data as we're kind of moving sideways and we're not outright declining anymore, where we're kind of flatlining here. So it's another sign of improvement. Overall, though, the general condition activity is still lower. So here's the composite regional Fed survey data, minus 10.1, so well below its peak. But again, you can see some sideways movement and some reacceleration here. Again, another sign of improvement. I'm bouncing around and I apologize there. So there's just a lot of data that's come out and we're trying to square it as best we can. So in my framework, my whole thought here was the economy and the market were going to trend somewhat sideways here, that as the demand in the economy declined, prices would decelerate, but that decline in prices would then fuel some level of demand picking back up again. Maybe that's what we're seeing in 2023 and why everyone is feeling struggled or stressed about this cycle. Everyone was calling for a recession and now they're having to reevaluate that. I'm still in the camp that a recession is on the table, primarily because policy error can play an outside impact when the economy is growing below trend. And that situation can make the Fed raise interest rates more than they actually probably need to relative to the data that's been coming out. I think they should continue to pause here. I think they should continue to look at the progress they've made, allow the economy to continue to operate in a very restrictive environment, but they can continue to run down the balance sheet in the background. That's another form of tightening on the financial system, and that will, again, help them facilitate some restrictive stance of policy and yet hopefully bring the inflation back down to target here. So let me look at one more thing that came out this week. Let me look at durable goods orders. Those also came in better than expected. The consensus estimate was for minus 1% month over month. They came in at 1.7% month over month. The increase, particularly in durable goods, came primarily from transportation, which was up 3.9% month over month, with autos increasing 2.2% and non-defense aircrafts and parts up 32.5%. So I'm going to come down here. You can see durable goods reaccelerating back to trend, and again, being above trend, almost $832 million. If you take out defense, it doesn't look as good. It's just barely below trend, but again, reaccelerating. If you take out transportation, which was the strong point in this report, you see a flatlining of durable goods orders, and you can see that it is well below trend. So you can see that transportation is playing an outside factor of this. Let's go all the way down. There's a lot more in here, and you guys feel free to look at these on your own. But here's the transportation equipment. You can see that strong increase, the level above trend here. And here's those motor vehicles and parts, again, staying right along trend, just above trend, and that's looking pretty good as well. So to me, again, this looks like an economy that's growing below trend. To me, it looks like an economy that's remaining more resilient than people are giving it credit for. And it's partly because there's still demand for workers, and there's still some pay wages that are going up here. And that's what's keeping this cycle going as investors and consumers are going back out and spending. We didn't get into it, but even take the market action of late as the market continues to recover off of the back of this data, getting marginally better. And as it continues to get better, we then have to lean on company earnings then at that point to help continue to set the directional trend. That seems to me to be the last domino that needs to fall. The market here has been climbing walls of worry, and as the worries kind of come and go, such as the debt ceiling, such as bank failures, such now as bad earnings, as those dominoes continue to fall, the market continues to rally through them. I will say this, based on company earnings from FactSet, they're looking at somewhere as an earnings estimate of $247 per share by the end of 2024. And of course, that will continue to be updated as we get more guidance and as more releases. But looking at that relative to the PE that's on the market today, that would conclude, or you could actually forecast that maybe the S&P should be somewhere around 4,600 if you realize that $247 per share that these analysts are estimating. If that's the case, the market being here at 4,450 still has some room to run. But again, we're going to caveat that with earnings have to come in at what's expected or greater than expected for that to take place. So we'll see as that comes out. That's another thing for you to watch. And it's another thing to show the strength of the economy. If company earnings come in better than expected, then you've got another line of data that is improving, and we can't ignore improving data. When the data goes from bad to improving, you as an investor, you as citizens and consumers, as far as the overall health of the economy, should take note of that, as it could be signs that things are improving, should be signs for you to maybe take action in one direction or another. I'll close on this. I'll close on the Fed, because what does the Fed do in the face of all of these strong data releases? The fact that housing starts, building permits, new home sales, personal income, all coming in stronger, and you couple it with inflation going lower, this paints a picture that things are getting better. How does the Fed square this? Do they continue to be restrictive, or do they continue to say, hey, look, let's wait. Maybe we've achieved our soft landing. My fear is they stay tunnel visioned and they try to continue to be restrictive and continue to raise interest rates all the way back down to 2% inflation. What I think they should do is just continue to hold here and continue to just do quantitative tightening in the background. And I want to say that and conclude with that, because if the Fed were to stay tunnel visioned and stay focused on inflation, then I do think a recession is likely, as more tightening will continue to tighten credit standards, will continue to tighten lending standards. That will slow more economic activity, create more uncertainty on consumers that are looking at these bigger ticket items, and that could ultimately feed through to the financial markets, as higher interest rates means that safer investments are going to be really attractive to compete with very risky investments. And so to me, that seems to be a recipe or a road that they may not want to go down, and why they might want to reevaluate being too restrictive in the face of some promise here. So we'll see how that shakes out. Forgive me for jumping around, but there was a lot of data that came out, but I hope we gave you a good view of how that data is improving. One more data point that doesn't have a chart to it that I can also close on as well as the Michigan Consumer Sentiment Report. Sentiment was at 64.4% compared to 59.2%. So that's increased significantly as well. So again, just another sign that the economy and those in it are feeling more confident, feeling better, and seeing some improvement here. The all clear is not sounded, right? I mean, I'm still very cautious. There's still things out there that make me nervous and still have to show some signs of improvement. like financials. We'd like to see them lending, and I don't think we've quite seen the squeeze on net interest margins just yet, as deposit rates are still relatively low relative to the loans they're making. There's still some worry on the manufacturing side, as evident from the regional survey data, is that they're improving, but still very sluggish by nature. And I think there's still concerns geopolitically as well. So the all clear is not technically there, but there's always something going on, and that's what makes our jobs and the markets so interesting. So with that, I think that's a great place for us to stop. If you have any questions at all, don't hesitate to leave me a comment below or shoot me an email. I'll be happy to answer those for you. Your questions help me look and answer and dig into the data a little bit deeper to find you those answers. So feel free to reach out if anything is on your mind, or if you'd like to see a case study done. Also, if you haven't yet, like and subscribe to our videos. They continue to help us push these out and continue to make this ongoing effort to keep you informed that much more valuable and that much more helpful. So with that, we hope you have a great week. I know we're moving into the holiday weekend and Independence Day, so hope you have a happy 4th of July, safe 4th of July. We will be going on vacation that week, so I will not be back until, I believe, the 11th. So we will not have a weekly update next week, but we will continue to bring you these data updates. So with that, have a great week, and we'll talk to you soon.